Greece is very much at the forefront of everyone's minds right now. Just looking at what took place over the weekend, they weren't able to form a kind of a coalition, a government. The leftist Syriza party coming out saying that they won't accept the austerity measures. How's the market taking to this news? How's the market reacting to the uncertainty that is really gripping Greece right now?
Well, Samantha, I'd say that, it's actually all things Europe that's keeping markets on edge at the moment, not just Greece. I mean, you've touched on the fact that they've still failed to form any kind of government, never mind a coalition government. And this is now the second week running that we've been waiting on some sort of progress in Greece. But also we had an important election in Germany, some heavy losses there for Chancellor Angela Merkel's party. And that's been widely perceived to be a rejection of the anti-austerity measures that she's largely been pushing. And of course, in the background, there's still the remaining problems of countries like Spain and Italy, which are increasingly vulnerable and have fallen off the back, kind of fallen off the headlines for now as Germany and Greece have entered the fore. But those problems still haven't gone away. So I really think it's kind of the whole region that's still going to keep markets on edge for this week.
Of course, Spain was in focus on Friday with those banking reforms that coming out from the Spanish government, saying that an extra 30 billion euros must be put on the balance sheet in order to make provisions for those losses attached to toxic real estate. This is very much a flashback to what took place in America, of course, as a result of the housing meltdown there. What does this all mean for the currency market? Because looking at that euro, it was 129 this morning, it's dipped below 130. It hasn't really had a sharp sell-off, really, in light of the fact that this is all taking place.
No, but I think, when one looks at the euro over the last couple of years, in fact, we see that there hasn't really been much of a reaction, or certainly not the kind that one would expect to all the problems that have been going on in Europe. And we maintain that that's in part because a lot of the currency's value is driven by interest differentials. And at the moment, the interest differentials between the majors are relatively small. And that's why, you're not seeing the kind of moves between the currency majors, particularly related to euro weakness, that one might have anticipated. But having said that, the euro is broadly weaker overall, and so there is some evidence that what's happening in Europe is starting to take some strain on the currency. So going forward, we still see that the euro is likely to remain on pressure, probably likely to drift even further down. I mean, we've been calling for a low of about 118, 120 by the third quarter for some time now, and that was largely based on our view that the eurozone debt crisis is not going to go away, and until there is some reformulation either of how the states relate to each other or how fiscal policy is conducted within the union, this is going to be a recurring problem and is going to weigh on the euros for some time still.
Yeah, and of course those GDP numbers will be closely watched by the market, looking at consensus figures for quarter one, expecting a drop back, of course. Once again, we know that the euro is expected to be in recession, confirmed by those numbers. Looking at the previous quarter, it was down, the eurozone GDP number was down by 0.3%. What are the expectations at Standard Bank in terms of that headline number?
Well, our expectations are roughly in line with the market, i.e. we do see Europe slipping back into a recession, and that's been our base case scenario for quite some time. I think really what the issue is at the moment is how deep or how prolonged this recession is going to be, and for that we'd really have to keep an eye on developments and see how the political situation unfolds, particularly with this anti-austerity backlash that we're seeing.
Of course, China is in focus as well, and how they're managing their economy. Looking at the news over the weekend, they've cut the reserve requirement once again of the banks. That's estimated to be freeing up 400 billion won into the market. How's the market going to react to this? Because whilst Europe continues to play out, this is also an important factor to note. Is this a positive for the market, that excess liquidity and how it's managing the slowdown?
Well, certainly I think that the fact that they've cut their reserve requirement ratio and as wide speculation that they could cut again, that could certainly be seen to be a positive for the market, particularly for risky assets and risk sentiment. But I don't think that that's the main story at the moment. I think what's happening in China has been to a large extent overshadowed by weekend developments in Europe. So I do think that once the situation settles down to some extent in Europe, then the China story will come back to the fore, because certainly it is quite a positive development. China China does need to stimulate some internal demand, because even though the economy has held up relatively well against a backdrop of a slowing Europe, you are starting to see the effect of a weaker Europe in their numbers. Their GDP numbers slightly softer than expected, starting to see it weighing on exports as well. So it's not entirely a surprise that authorities are starting to take some moves there to boost the internal growth dynamics in China.
Looking at the rand, 8 rand 16 is what we're looking at right now. There have been some comments from Pravin Gordhan. Those sometimes affect the rand around the manufacturing sector, the fact that it has been hard hit. Does that have any implication for the local unit right now? Is it very much geared towards the international news flow?
I think it's very much geared towards international news flow, and of course with this week's data calendar being so heavily focused on international developments, it's likely that the rand will continue to take its cue from there. But certainly comments from the finance minister are always worth watching, and to that point he was making the point that he sees the slowdown in the manufacturing sector as being hopefully temporary, and of course should the rand continue to depreciate in the way that it is currently, you could see the manufacturing sector get a bit of a reprieve from that.